Financing mixed-use and commercial properties can be complex but highly rewarding if done strategically. Here's a detailed guide on financing options for these property types, along with pros, cons, and tips to optimize your approach. FHA loans. Overview. Available for properties with up to 4 units, as long as the owner occupies 1 unit. Commercial space must not exceed 49% of the total square footage. Pros: low down payment, as low as 3.5%. Low credit score requirements: 580 for 3.5% down, 500 for 10% down. Competitive interest rates. Cons: requires owner occupancy for at least 1 year. Commercial income may not be considered in loan qualification. Best for first-time investors using a house hacking strategy. Example: purchase a mixed-use property with retail on the ground floor and residential units above for $400,000, putting down only $14,000. Conventional loans. Overview. Traditional loans offered by banks or credit unions for properties with up to 4 units. Can finance both owner-occupied and investment properties. Pros: no owner occupancy requirement for investment properties. Can be used for mixed-use properties with a strong financial profile. Cons: higher down payments, 15 to 25% for investment properties. Requires a good credit score, typically 680 or higher. Best for investors with strong credit and capital reserves. Example: buy a mixed-use property for $500,000 with a 20% down payment, which is $100,000. Portfolio loans. Overview. Offered by private banks or lenders, portfolio loans are tailored to investors with unique needs. Pros: flexible terms based on your financial profile. Can cover unconventional or mixed-use properties. Cons: higher interest rates than conventional loans. May require a relationship with the lender. Best for investors with multiple properties or complex financing needs. Example: a local bank offers a loan for $800,000 to purchase a mixed-use building based on your portfolio's performance. SBA 504 loan. Designed for small businesses, this loan can finance mixed-use properties, if at least 51% of the property is owner-occupied. Pros: low down payment, typically between 10 and 15%. Fixed interest rates for the life of the loan. Cons: you must occupy part of the property. It has a longer approval process with more documentation. Best for investors planning to run a business in the commercial portion of the property. Example: you can buy a $1 million mixed-use property with $100,000 down using an SBA 504 loan. Commercial mortgages. These loans are specifically designed for properties used solely for business purposes like office buildings or warehouses. Pros: they are tailored for income-producing properties and allow for larger loan amounts than residential loans. Cons: they require higher down payments, usually between 20 and 30%. The terms are shorter, ranging from 5 to 10 years, with amortizations up to 30 years. Best for experienced investors with strong financial profiles. Example: secure a $2 million loan for an office building with a 25% down payment, which would be $500,000. SBA 7A loan. This general-purpose loan can finance commercial properties, particularly for small businesses. Pros: it has a low down payment, sometimes as little as 10%, and offers long repayment terms, up to 25 years for real estate. Cons: it requires owner occupancy of 51% or more. The application and approval process can be lengthy. Best for business owners purchasing commercial properties for their operations. Example: use an SBA 7A loan to buy a $1.5 million office building with $150,000 down. Hard money loans. These are short-term loans offered by private lenders, often used for properties needing renovations or quick purchases. Pros: they offer fast approval and funding, often within days. Plus, they have minimal credit requirements and focus on the property value. Cons: they come with high interest rates, often between 8 to 15% or more, and short repayment terms, typically 6 to 24 months. Best for: these loans are best for flippers or investors needing quick financing for value-add properties. Example: you might use a hard money loan to purchase and renovate a retail property for $500,000, paying it off after refinancing or selling. Bridge loans. These are short-term loans that bridge the gap between purchasing a property and securing long-term financing. Pros: they provide fast funding for opportunistic purchases and offer flexible terms for transitioning properties. Cons: they have high interest rates, usually between 6 to 12%, and short terms, typically 6 to 36 months. Best for bridge loans are ideal for investors transitioning properties from distressed to income-producing. Example: you could secure a bridge loan to purchase a partially leased office building for $1 million and then refinance after stabilizing occupancy. Real estate syndication or partnerships. This involves pooling funds from multiple investors to finance large commercial deals. Pros: it allows you to spread financial risk among partners and gain access to larger and more lucrative properties. Cons: it requires shared decision-making, and profits are divided among partners. Best for: this strategy is best for investors with limited capital looking to diversify. Example: you might partner with 4 investors to acquire a $3 million retail center, with each contributing $300,000. General tips for financing: improve your credit score. Aim for 700 or higher for the best terms. Pay down debts and avoid new credit inquiries before applying. Prepare a strong business plan. For commercial and SBA loans, include projections, property financials, and market analysis. Leverage rental income. Use projected rental income to boost your qualification for larger loans. Negotiate terms. Work with lenders to secure favorable interest rates, terms, and conditions. Explore tax incentives. Use programs like opportunity zones for tax benefits when investing in certain areas.